The Fed kicks off its latest meeting today, and a lot of economists are expecting a 25 basis point rate cut tomorrow. Joining us right now on that and the Fed independence conversation is former Dallas Fed President Rob Kaplan. He's now vice chairman at Goldman Sachs. And Rob, let's pick up with what Scott was just talking about, this idea that former President Trump and upcoming President Trump has said that he would not renew Jay Powell. Scott just said maybe that it makes the Fed even more independent over the next couple of years. What do you think?
I think the Fed will act independently this year and next year, and they'll do their best to screen out political influence and political considerations. That's what they've been doing, and I think they'll continue to strive to do that. And
that Fed operating under independence should be doing what, you think?
So they'll go ahead and make a cut in November to 25, down 25 basis points. I think December they'll leave their options open. They won't commit to it. And they've got to take some time to see how the economy unfolds and how these policies unfold. I've been saying for a while that there's two phases of the rate cutting. Phase one is as long as inflation is sticky around 2.5, they can get to say 4.25, 4.5. But they need to see progress from 2.5 to 2, in my opinion, to cut rates lower. And I still think that's the approach they'll take.
Okay, let's talk through some of these potential policies. I'm assuming you heard this conversation we just had with Scott.
Yeah, I did.
Okay, let's talk about the idea that if they rein in spending, whether that be cutting back the IRA, the CHIPS Act, trying to cut government spending. I don't know how effective they'll be able to be with some of those initiatives, but if they do rein in spending, that would be anti-inflationary. Then you take the idea of lower taxes, put that where you want in the pot. Tariffs could be inflationary. How do you see all of this adding up?
This is going to be a mosaic. It's going to be a puzzle, and you're going to have to look at it holistically. So the first issue I'd look at is what are the immigration policies, and what's the effect on workforce supply? Does it actually go down, or is it more manageable? But that's the number one question. What the immigration policies and some of the things that have been said, what do they actually do? Tariffs we've talked about. Remember, tariffs is just on goods. Goods is 30% of the economy, and people are dynamic. If things are more expensive, they substitute. They buy other things, and some of this may be negotiating. There's going to be a significant regulatory review economy-wide with the intention to improve productivity per capita. That's disinflationary. There's going to be, I'm sure, and Scott mentioned it, a focus on energy policy and probably pressuring Saudi Arabia and domestic producers to produce more. And so you'll have to look at the mix and how it unfolds. But I'd be careful not to prejudge it. I think the one thing I'm very sensitive to, and they'll be sensitive to, debt to GDP went from 70% pre-COVID to over 100%. And we're seeing the term premium on the Treasury market inching up, meaning we're paying more to sell duration in Treasuries. And I think managing the debt load and how we do it is going to be a significant challenge.